You are listening to the Cresco Wealthcast, a podcast brought to you by Cresco Wealth Management of Wellington Altus Private Wealth. I'm your host, Dimitri Karolis, and I wanted to bring a podcast from the world of wealth that was really just easy to follow. And from time to time, I'm going to be bringing in members of the team. We'll be bringing in external guests and really providing some good information that are inspired from those coffee talk conversations that not just we're having, but that you're having as well. You can follow the podcast on www.cresco.podbean.com, or if you're on Spotify, you can just search for the Cresco Wealthcast. And last but not least, please do not forget to subscribe to my channel on Instagram, which is at the Finance Greek. Okay, welcome back to the Cresco Wealthcast. As promised in the episode before, we have Wayne DeBoer. Look at that rhymes. It's almost as if I scripted and wrote it for a rhyme. It's just so easy. But we talked about insurance. We give a good overview, and I should say by we, you, Wayne, again, our senior financial planner, I should mention. You gave a really good overview on insurance. It was a great conversation. And we promised we would dive a little bit deeper. And so what to expect is we're going to do a series of two short episodes here. This first one being focused on life insurance, the next one on disability and critical illness. But let's just start with life insurance. That really seems to be the big one, and it can mean a lot of things. But why don't we dive into life insurance, really the types of life insurance and their purpose, and however you want to dissect that way.
Yeah, sure thing. Thanks, Dimitri. I guess where I would start where I start when I'm talking with families about life insurance is kind of what do we need it for? Life insurance can be used for two main things, as I mentioned in the last episode. One is kind of risk protection, like if there's a loss of an income because someone passes away, what does that mean for your family? And then the second one can be more of a tax planning, estate enhancement type of conversation. But depending on what you need, that's really going to start to focus us in on different types of insurance policies. So the first one being kind of a term life policy. So a term life policy, I sometimes call it rental insurance. What you're doing is you're taking out insurance and you just need it for a specific reason, for a specific purpose of time. So it's kind of that foundational insurance every family should consider having. People will have it with their group insurance sometimes through work. As I said in the last episode, I don't think that's often enough for people. But then there's also personal policies that you can have on top of that, which typically tend to be a little more robust, have a few more features, and you have more control of.
Okay. With those term policies, usually you'll see a term 20, term 10. Can you manipulate them? Can you have a term 14, a term 27? How do they work, these things?
Yeah, actually, that's a great question, and you can. Not necessarily with every insurer, but most insurers offer a basic term 10, term 15, term 20, and what that means is your premiums are locked in for that period of time. Once that term is over, what you can do is the policy will often renew automatically. The policy doesn't lapse or expire, but the premiums are then locked in for another band of the same amount of time, just at higher rates. Now, some insurers recognize that families do have specific timelines that they want to have coverage for. Maybe it's a business owner who's planning on selling a business or retiring, and they say, I do want a term 14. And yes, we can actually go to specific insurers and ask for a term 14.
Okay. No, that's good to know. Yeah, thank you. So, that encapsulates really the terms and the duration. And maybe I cut you off with that question, but let's go through even the other one. So, that's the term side of things. What about whole life or universal policies? These are some other buzzwords that get thrown at us.
Yeah, so typically with a whole life or a universal life policy, Dimitri, what we'll see is someone knows that they need coverage for a longer period of time. So that could be due to they're planning for a family cottage, and they want to make sure that their estate has the liquid cash needed to pay the taxes. It could be that they've done some business restructuring in the past and their estate's going to have a tax liability from their business, from some preferred shares, and they know that they need that coverage down the road. So we'll often look at either a universal life or a whole life policy in that situation. Now, what we'll often see with a universal life policy, it kind of debundles all the aspects of a permanent policy in that there's premiums that go in. Some of those premiums are then used to pay for the cost of insurance. But you have options with that. You can either have that cost of insurance level for the rest of your life, or it can change every year. And the choice is really situationally dependent between those. A whole life policy, on the other hand, that one you don't get to make as many choices around things. Just to back up to the universal life policy, once you've put your money into the policy, you can then start to choose what types of investments you want to have that policy invest in. So whether it's global equities, Canadian equities, fixed income, guaranteed interest accounts, you have all these choices and all these options for where your money goes and how that impacts your future death benefit.
Good.
A whole life policy, on the other hand, is typically a little more restrictive in terms of what you can invest in. Usually, the insurer has its own pool of assets. Those assets can, in some cases, be participating in the overall insurance company's claims experience and costs and profits potentially. And then some insurers with a whole life policy, they just have a specific asset mix that you participate in, and it separates that claims experience from it.
Okay, no, it's good to know. And I know maybe you can't answer. Uh, of course, there needs to be a needs analysis and some insight, but sometimes when you look at universal or whole, it could be propositioned in the way of, hey, here's your best bang for your buck, just do it once, have it settled, and be done. What should someone look for as a decision maker of why term might be a better fit versus a whole life, and or vice versa?
Yeah, so if you're looking at that term versus permanent conversation, there's a couple things you have to look at. One is, what's my budget? If you have a need for insurance and your budget is a little bit restricted, you've got to look at the term coverage. You're going to get way better bang for your premium buck going that path. If you're looking at permanent, whether it's in a universal life or a whole life type of environment, or even term to 100, there's all sorts of different types that exist. You need to recognize that because the insurance company is counting on you keeping this policy in force for the rest of your life, your premiums are going to be higher. So for some people, they have the budget for that. For other people, they might look at that and say, well, if I only have a premium budget of $2,000 a year, whatever the number might be, I'll get permanent, but I'll take way less coverage. And I would say that's a dangerous trade-off to make, because if that $2,000 premium only buys you 15% of the insurance coverage that your family needs, I would say that that's not a particularly effective strategy. So that's why that needs analysis, figuring out what the premium budget is so important in making that decision.
Why don't we talk, if we have some time here, even some of the features and riders that are involved in some of these policies?
Yeah, I think that that's one of the things that separates a personal policy from a group policy so much. What we'll see with a personally owned policy, Dimitri, is once you've gone through underwriting, it's in place. The insurance company's had a chance to evaluate your health, their risk, and then make an offer to you. So what that means is some of the options and features you'll see within these policies just have to, they give you extra little perks. So what you might see with some of them is, I've got a policy where I've added my kids on for a small benefit, and then it gives them the ability to buy insurance in the future, no matter whether they're insurable or not. Sometimes you'll see exchange privileges with a policy. So I've had this in the past where a client has maybe got a term 10 because the coverage was cheap and they expected to be healthy at the end of their 10-year term when their new premiums were much higher. And then they had a change in health. Well, their policy allowed them to exchange their term 10 for a term 15 or a term 20, a longer term policy without having to prove that they're insurable anymore. So that's another nice feature you'll sometimes see in these policies.
So that's great. I just have a quick question on that. What in that scenario? we do the exchange, and let's say from that term 10 and now becomes they elect to go term 20, and there's a health change, as you say. Uh, do you have to report the health change? And if you do, does that change anything at that point as well? Like, what is the process there?
No, you don't have to. As long as you do it with this particular insurer,
Yeah.
and others as well, within the first 5 years of the policy, there's no additional underwriting. There's no verification of your health status that has to happen. And I think that's one of the things that's so important. The insurance company, when they did the original underwriting at the time of the application, they knew that this is something that they were taking on, and they took on that risk themselves. And so that's one of the reasons I think a personal policy is so valuable versus a group policy.
So I'm just thinking the questions that, someone listening right now and says, oh, maybe should I hide because does that ruin the policy? And I don't know if I want to reveal it. And so they would be within those parameters.
Yep.
Covered.
Yep.
Excellent.
So insurance companies typically have a 2-year contestability period for a policy,
Okay.
where they can, go back on the offer if something was misstated. Okay. However, after that 2-year period is over, the insurance company's bound unless you committed fraud, straight up fraud. They're on the hook for the terms of those contracts. Another perk that we'll see in these personal policies, particularly the term ones, is the ability to convert. And so, what a conversion privilege is by a certain age, you can then trade in your personal term policy for a permanent policy that's offered by the insurance company at that point in time. So, right now, if you were 30 years old and you said, hey, I need a $1 million or a $2 million term policy to protect my family, you put that in place. 20 years down the road, your situation's changed. You have a cottage, you have a business, an asset that you need to have some permanent coverage for. Guess what? You don't have to go through underwriting again. You can just trade in your term policy for a permanent one without underwriting. And those are the types of things that you'll often find in some of these life insurance policies. You will also see the ability to buy more insurance coverage in the future without underwriting. So there's a whole bunch of reasons why someone should maybe consider looking at a personal policy, going through underwriting if they need insurance, and then exploring what options all exist.
Yeah, because everything is a little bit different. And let's go with the term rider. What does that mean? You're sitting down. A lot of these words and phrases, yes, they mean something to us, but if you could just explain the term rider, what is a rider? What does it mean? What does it mean to the person who has the policy?
Yeah, so a rider on a policy is basically an additional option or feature. So within the context of these life insurance policies, it could be that your base policy is just a death benefit. But then you say, I want some coverage on my children. Okay, we can add a rider that gives coverage. It's maybe not a feature that was available independently, but when you add it on, it sort of rides along with the policy and then becomes part of the policy that you ultimately end up putting in place.
Yeah, excellent. And these are something that can be added really, dare I say, any time. But this is, if someone in that 30-year-old has done a term policy, but then life has changed with kids, situation, home, whatever, this is something that can be added on to that policy.
For children's coverage, yes, depending on the insurer.
Yeah.
Other types of coverages, other types of riders, you have to apply for at the time of your initial underwriting. So, for example, sometimes you can get a waiver of premium if you're disabled. Well, the insurer is going to let you apply for that when you take out the policy. But 5 years later, if you suddenly come to an insurance company and say, hey, I want to add this, they're going to, sort of squint at you, raise one eyebrow, and they're going to say, what happened to you that you want to add this now? So yes, some you can add after. There are some changes you can make after a policy is in force. You can change your smoking status. So if you were originally a smoker, you can become a non-smoker. But other types of changes you can't make after the original underwriting.
This was my cheeky roundabout way to educate our listeners as to why talking to a real professional on a real needs analysis is important structurally to make sure you're getting the right type of coverage. No, I appreciate that, Wayne. This is very informative. Anything to add that maybe we've missed for today?
I just think the key takeaway for anyone listening today should be, look, insurance is an important part of the overall wealth planning process, especially when we start thinking about life insurance, because the loss of a life, putting the emotional side, putting the emotional loss and difficulty aside, the financial implications of that are enormous. And no matter what your need is, there's something that can help protect, and it really is a key part of the overall wealth planning process to make sure that your future is protected from these unexpected events. So yeah, I guess that would be my takeaway. It's working with someone who really wants to get to know who you are, what your needs are, what your goals are. If they then start talking to you about insurance, just know that it is a truly important part of your overall plan. Just make sure you get the right type of coverage in place that protects your family and helps you get to where you want to go.
Yeah, appreciate it, Wayne. Again, Wayne DeBoer, Senior Financial Planner for Cresco Wealth Management. It's a privilege definitely to have you on the team. As we've talked about at the beginning of this episode, and if you've been with us on this little insurance journey that we're taking you on, stay tuned for the next episode. We will be tackling disability and critical illness insurance and really going through a very similar type of overview. Of course, do not hesitate to reach out to us. You can, if you go to crescowealthmanagement.com, you can find Wayne's email and myself if you have any questions for us, or if you want to directly message as well, you can. I have my Instagram channel at The Finance Greek, and of course there's the Cresco Wealth Management, I should say at Cresco Wealth Management inbox as well. But please follow, subscribe. Thank you for listening to the content, and we will be back. I say shortly, but upload time, we'll see you in a week or so.